The greatest macro mystery in this time of COVID is the stock market. How is it possible that stocks bounced back from Armageddon in March to all-time highs in September in the face of a sweeping global pandemic and an unprecedented economic collapse? If you look at stock markets, you will see 5 distinct boom and bust cycles over the past 20 years. The 5th cycle has now been underway since the end of March, and the open question is, will we continue to new highs and a fully fledged bull market, or resume the descent begun during the pandemic? Several critical market drivers can help us to find our way towards answering this question. First, the relationship between the economy and the stock market, where it is changes in expectations about the economy that drive stocks, not the actual performance when it finally arrives. This is important to remember this year, with the economy still in partial recovery while stock markets roar ahead in anticipation of higher profits in the future. Where does the economy go from here? Well, in a word, up. This is not to say that growth will necessarily be robust, but there is no reason to expect another repeat recession anytime soon. Overall, a continuing economic expansion is a positive for stock prices going forward. The next important market driver is monetary policy, conducted by the U.S. Federal Reserve. The Fed uses 2 main policy levers these days to affect the economy and markets: interest rates and their balance sheet. The policy reaction in 2020 saw a $3 trillion swing in the balance sheet, fully 3 times the reaction in 2008, and interest rates are back down near zero. This was done to successfully avoid a financial crisis, which would have immensely compounded the pain from the pandemic. Where does the Fed go from here? They have pledged to keep rates flat until at least 2023, and we should expect little change in the balance sheet. On net, that is highly supportive for stock prices. And other markets, notably real interest rates, the yield curve, and the US dollar, are currently either positive or neutral for stock prices. There's plenty of risk in the market already, given high historic valuations, the pandemic, and the pending US election. However, the weight of evidence is for rising stock prices over time, and not a decline and eventual crash. That latter scenario requires a change in fundamentals, like renewed recession, tighter Fed policy, or a financial crisis, and it will not be triggered merely by pessimistic expectations. So, even though stocks are near all-time high valuations and are therefore very expensive for investors, my guess, and it's a guess like any other, is that they will only become more expensive. All hail the new Roaring '20s and on towards the next peak. I'm Mark Mullins.
Commentary That Matters is a partner program of Conversations That Matter. The production of this show is made possible thanks to your generous support. Please become a Patreon at patreon.com/commentary that matters and become a subscriber so that you don't miss a single episode of Commentary That Matters.